Before we dive in, please remember that I am not a licensed financial advisor or attorney. This video is for educational and entertainment purposes only and should not be considered legal or financial advice. Always consult with a qualified professional before making any decisions about your insurance coverage. Imagine this. You're sitting at a red light on the Mass Pike connector, just trying to get home after a long day. You're listening to the radio, thinking about what's for dinner. Suddenly, a violent jolt throws you forward. Your head snaps back. The world is a blur of screeching tires and shattering glass. Someone has just plowed into the back of your car. You're shaken, but you seem to be okay. You get out, heart pounding, and see the other driver stumbling out of their vehicle. They're apologetic, they're frantic, but then they drop a 5-word bomb that changes everything. I don't have any insurance. In that single moment, your simple fender bender has morphed into a potential financial catastrophe. Who pays for your car? Who pays for your medical bills if that neck stiffness tomorrow turns into months of physical therapy? Who covers your lost wages when you can't work? Suddenly, a piece of paper you probably haven't looked at since you bought your car, your auto insurance policy, becomes the single most important financial document you own. And what if I told you that for the vast majority of drivers in Massachusetts, that document is a trap? That the standard or minimum coverage you're paying for every single month is practically designed to fail you in a moment just like this, leaving you exposed to financial ruin. That is the exact problem we are going to solve in this video series. This isn't going to be another boring, jargon-filled lecture about insurance. This is a masterclass. By the time you're done watching, you will understand your Massachusetts auto policy better than 99% of the drivers on the road. You will know exactly what you're paying for, what you're protected from, and more importantly, where the hidden trapdoors are that could swallow your savings, your home, and your future. We are going to transform that confusing packet of paper into your personal financial fortress. And let's be clear, Massachusetts is a different beast. We're not like other states. We have what's called a compulsory insurance state with a no-fault system, which creates a unique and often confusing web of coverages. What works in New Hampshire or Connecticut doesn't necessarily apply here. That's why we're focusing exclusively on the Bay State. So, let's start at the very beginning with the absolute foundation of your entire policy. It's the part that is legally required. It's called liability coverage. The name sounds simple, but this is where the first and biggest mistakes are made. Liability coverage has absolutely nothing to do with you, your passengers, or your car. Zero. Its one and only job is to pay for the damage you cause to other people and their property when an accident is your fault. You are paying for protection against someone else suing you into oblivion. It's broken down into two main parts: bodily injury to others and property damage. Let's tackle bodily injury first. In Massachusetts, the state minimum, the bare-bones legal requirement, is what's known as 20/40th. You've probably seen these numbers on your policy. They look like a fraction, but what do they actually mean? The first number, the 20, stands for $20,000. That is the absolute maximum your insurance company will pay for any single person's medical bills, lost wages, and pain and suffering in an accident that you cause. The second number, the 40, stands for $40,000. That is the absolute maximum your insurance company will pay for the entire accident, no matter how many people are injured. $22,000. Let that sink in. It might sound like a decent amount of money, but in the world of modern healthcare, it's a rounding error. Let's create a scenario. You're driving in Boston, you glance down at your GPS for a split second, and you accidentally run a red light, T-boning a minivan. Inside that minivan is a mother and her 2 children. All 3 are injured and need to be taken to Mass General by ambulance. The mother has a broken arm, one child has a concussion, and the other has a fractured leg. Let's start the clock. An ambulance ride in a major city can easily cost $2,000 to $3,000 per person. So right off the bat, we're looking at maybe $7,000, $8,000, $9,000 gone before they even get through the emergency room doors. The ER visit itself with diagnostics, x-rays, and CT scans for a concussion will be thousands more. The mother needs surgery to set her broken arm, which can run from $10,000 to $15,000 or more. The child with the fractured leg needs a cast and follow-up visits. The child with the concussion needs to be monitored and may need to see specialists. Add in weeks or months of physical therapy for everyone involved. Suddenly, that $20,000 per person limit doesn't just look small, it looks insulting. The mother's bills alone could easily hit $30,000 or $40,000. But your policy only covers her for $20,000. What about the other $10,000 or $20,000? And what about her pain and suffering? What about the wages she loses because she can't work with a broken arm? That's not even on the table yet. Your insurance company writes a check for $20,000 and says, "That's all we're on the hook for." So where does the rest of the money come from? Comes from you. The family's attorney will send you a letter demanding payment for the rest. If you don't pay, they will sue you. And they won't just sue for the remaining medical bills. They will sue for everything. Lost income, future medical care, emotional distress, physical pain. Suddenly, you're facing a lawsuit for $100,000, maybe more. And your insurance company, the one you've been paying faithfully every month, is only legally obligated to cover that first $40,000 for the total accident. That leaves you personally on the hook for the rest. Your savings account? It's gone. The equity in your home? They can put a lien on it. They can even garnish your future wages, taking a piece of your paycheck every single week for years until the debt is paid. All because you made one tiny mistake behind the wheel and had a policy with paper-thin 20/40th limits. That's the bodily injury trap. Now let's talk about the second part of liability, property damage. This is the part that pays to repair or replace whatever you hit, whether it's another car, a mailbox, a storefront, or a guardrail. The state minimum required coverage in Massachusetts for property damage is $5,000. $5,000. Let's be brutally honest. That is not just inadequate, it's a joke. It's a number that might have made sense in 1975, but in today's world it's completely disconnected from reality. The average price of a new car in the United States just crossed $48,000. Think about the cars you see every single day on your commute. The roads are filled with Teslas, Audis, BMWs, new pickup trucks, and high-end SUVs loaded with expensive sensors, cameras, and computers in their bumpers. So let's play out another scenario. You're trying to back out of a tight spot in a Whole Foods parking lot. You misjudge the distance and put a small dent and a long scratch in the door of the brand new Lexus SUV next to you. No one is hurt. It seems minor. You exchange information and you assume your insurance will handle it. A week later, you get a call. The body shop estimate for the Lexus came in. Because it has a special pearl white paint and a sensor in that door panel, the repair bill is $9,000. Your insurance company will pay the first $5,000 because that's all your policy covers. Then they will politely inform you that you are personally responsible for the remaining $4,000. $4,000 out of your pocket for a parking lot mishap. Imagine if you hit something more expensive. What if you swerve on a wet road and hit a brand new F-150? Or a Mercedes? What if you cause a multi-car pileup? That $5,000 will be gone in an instant, and you'll be left to pay the rest. It's financial Russian roulette. This is the dirty secret of minimum liability coverage. The 20/40/5 limit isn't a recommendation from the state. It's not what they think is good coverage. It is the absolute lowest, thinnest, most pathetic level of insurance you can legally buy to avoid getting a ticket and a registration suspension. It's designed to check a legal box, not to actually protect you or your assets in a real-world accident. It provides the illusion of safety, while leaving your entire financial life hanging by a thread. So let's pull on that thread. Let's see just how quickly your entire world can unravel with state minimum coverage. Imagine this. You're driving home on a Friday afternoon. You're thinking about the weekend. Maybe you glance at your phone for just a second, a single fleeting second. But in that second, the car in front of you slams on its brakes. You react, but it's too late. The crunch of metal is sickening. You're okay, a little shaken, but okay. The driver of the other car, however, is clutching their arm and complaining of neck pain. The ambulance comes. It's a scene you've driven past 100 times, but now you're the one standing on the side of the road, watching the flashing lights. You did the right thing. You got insurance. You have the Massachusetts minimum, $20,000 per person, and $40,000 per accident for bodily injury to others. You think, 20 grand should be plenty for a sore neck, right? Wrong. Dangerously wrong. This is the first and arguably most important part of your liability coverage. It's officially called Bodily Injury to Others Part 1. This is the money your insurance company pays out when you are at fault for an accident that injures another person. It covers their medical bills, their lost wages, and something notoriously vague and expensive called pain and suffering. Let's break down those numbers on your policy. The 20/40 split. The first number, $20,000, is the absolute maximum your insurance will pay for any single person you injure. The second number, $40,000, is the absolute maximum your insurance will pay for the entire accident, no matter how many people you injure. Let's go back to our crash scene. The person you hit gets taken to the emergency room. The ambulance ride alone can cost between $1,000 and $2,000. The initial ER visit, with diagnostics like a CT scan to check for head or neck trauma, can easily be another $5,000 to $10,000. They discover a fractured wrist that requires surgery to set the bone with a plate and screws. The surgeon, the anesthesiologist, the operating room fee, that's another $20,000 minimum. And we haven't even accounted for a single overnight stay in the hospital, which can run $3,000 to $5,000 per night. Do the math. We are already well past $40,000 in medical bills. Your protection, that state-mandated $20,000 policy, was exhausted before the patient was even wheeled out of the operating room. It was gone in less than 24 hours. Every single dollar above your $20,000 limit is now your personal problem. The hospital, the surgeon, the radiologist, they all want to be paid. And since your insurance has tapped out, they're going to send those bills directly to you. But that's just the beginning of the nightmare. Remember, bodily injury coverage isn't just for medical bills. What about their lost wages? The person you hit is an electrician. With a shattered wrist, they can't work for the next 3 months. If they make $60,000 a year, that's $15,000 in lost income that you are now personally responsible for repaying. So now you're on the hook for tens of thousands in medical bills plus $15,000 in lost wages. Your personal debt is climbing, and we haven't even gotten to the biggest financial threat of all: pain and suffering. This is the legal term for the physical pain, the emotional distress, and the loss of enjoyment of life that the injured person experiences. There's no simple receipt for this, so how do attorneys calculate it? A common formula they use is to take the total medical bills and multiply them by a factor, usually between 1.5 and 5, depending on the severity and permanence of the injury. Let's be conservative. Let's say the total medical bills were $40,000. Let's say the attorney uses a low multiplier of 2. That's an $80,000 demand for pain and suffering. So let's tally up your personal bill. We have $20,000 in medical bills that your insurance didn't cover. We have $15,000 in lost wages. And now we have an $80,000 demand for pain and suffering. You are now personally facing a bill for $115,000. All from a 1-second glance at your phone. And how do they collect that money from you? They file a lawsuit. You'll get served papers. You'll have to hire a defense attorney, which costs hundreds of dollars an hour. Money you have to pay out of your own pocket because your insurance company has no obligation to defend you for claims that exceed your policy limits. They paid their $20,000, and they've washed their hands of you. If you lose the lawsuit, and you will because you were at fault, the court will issue a judgment against you. This judgment gives the other party's attorney the legal power to seize your assets. They will look at your bank accounts, your savings, your checking, your kids' college fund gone. They will look at your investments, your 401k, your brokerage account gone. They can put a lien on your house, meaning you can't sell or refinance it until they are paid. If you don't have enough assets to cover the bill, they can go after your future. It's called wage garnishment, a court order that diverts a percentage of every single paycheck you earn directly to them, for years or even decades, until the $115,000 debt is paid in full. Your entire financial life, everything you've worked for and everything you hope to build, is destroyed. Because you settled for the legal minimum. You checked a box instead of buying real protection. Now, how do we prevent this catastrophe? It's shockingly simple and inexpensive. You increase your limits. Instead of the state minimum 20/40ths, a responsible level of coverage starts at $100,000 per person and $300,000 per accident. That's written as 100/300. An even better, highly recommended level is $250/500. Let's replay our accident with $250/500 coverage. The person is injured. The medical bills are $40,000. The lost wages are $15,000. The pain and suffering demand is $80,000. The total claim is $135,000. What happens now? Your insurance company writes a check. That's it. The entire $135,000 is paid by them. You don't get a single bill. You don't get sued. Your savings are safe. Your house is safe. Your future paychecks are safe. The insurance company will even appoint and pay for an attorney to defend you and handle the entire settlement. You paid them a premium to take on this risk, and now they are doing their job. You have transferred the risk from your personal net worth to a multi-billion-dollar corporation. That is the entire point of insurance. And what is the cost for this incredible wall of protection? The difference between the pathetic state minimum and a robust $250-500 policy might be $20 or $30 a month. Maybe less. The price of a few cups of coffee. The price of a pizza. Think about that. For the cost of one large pizza a month, you can protect yourself from a $100,000, $200,000, or even a $500,000 lawsuit that would otherwise bankrupt you and your family. There is no better return on investment for your personal safety on the planet. We've just protected your life savings from a lawsuit over a broken bone. But what about the car you hit? What happens when you don't just injure the driver, but you completely total their brand new $60,000 SUV? That's a completely different part of your liability coverage, with its own set of limits and its own set of traps waiting for the unprepared. This part of your policy is officially called Part 4, damage to someone else's property. And just like with bodily injury, the state of Massachusetts sets a mandatory minimum amount you have to carry. That minimum is $5,000. Let me say that again. $5,000. At first glance you might think, okay, $5,000, that's not nothing. It'll cover a dent or a busted bumper. And you'd be right. But we're not talking about a parking lot fender bender. We're talking about the scenario we just set up. A $60,000 SUV that you just turned into a heap of twisted metal and shattered glass. Your policy, with its $5,000 property damage limit, is going to pay out that $5,000 to the owner of that SUV. And then it's done. Your insurance company dusts off its hands, their obligation is met. But there's still a $55,000 problem. And that problem has your name written all over it. This is the moment where your life can take a sharp, terrifying turn. The other driver's insurance company isn't just going to write off a $55,000 loss. They have a whole department staffed with very serious people, whose entire job is to get that money back. This process is called subrogation. It's a legal right that allows an insurance company to step into the shoes of their policyholder and sue the person who was at fault to recover the money they paid out. So, what does this actually look like for you? Starts with a letter. A very official, very intimidating letter from a law firm you've never heard of, demanding you pay them $55,000. Immediately, you might ignore it. You might throw it away, hoping it's a mistake. But then another one comes. And another. Then the phone calls start. They will call you at home. They will call you at work. They aren't trying to be your friend. They are collecting a debt. A very, very large debt. If you can't pay, and let's be honest, who has an extra $55,000 lying around? They will sue you. And they will win. Because you were at fault. A judge will issue a judgment against you. And with that judgment, they can begin to systematically dismantle your financial life. They can garnish your wages, taking a percentage of your paycheck every single week before you even see it. They can put a lien on your house, meaning you can't sell it or refinance it without paying them first. They can freeze your bank accounts. Your credit score will be annihilated, making it nearly impossible to get a car loan, a mortgage, or even a credit card for years to come. Every single bit of this financial nightmare, this constant stress and pressure that can last for a decade or more, all stems from one single decision: trying to save maybe $10 or $15 a month by carrying the state minimum property damage coverage. It is, without a doubt, one of the riskiest financial gambles a person can take, and most people don't even realize they're taking it. And that $60,000 SUV? That's not even a worst-case scenario. Not even close. Let's rewind. Let's say you run that same red light, but this time you don't just hit one car. You hit a brand new Audi Q7, worth about $70,000. The force of the impact pushes the Audi into the car in front of it, a 5-year-old Honda Accord. That's another $15,000 in damage. The Honda then gets shunted forward, hops the curb and plows through the front of a boutique coffee shop, shattering a plate glass window and destroying a display case full of expensive merchandise. Let's conservatively call that another $20,000 in damage to the building and its contents. Let's add it up. $70,000 for the Audi, $15,000 for the Honda, and $20,000 for the coffee shop. That's a grand total of $105,000 in property damage from one single moment of inattention. Your insurance policy, with its $5,000 state minimum limit, pays its $5,000. You are now personally on the hook for the remaining $100,000. $100,000. How long would it take you to pay that back? At a wage garnishment of a few $100s a week, you could be paying for this one mistake for the rest of your working life. This is why the $5,000 minimum is so dangerous. It provides a completely false sense of security. It allows you to be legally insured, but functionally, you're not insured at all for any kind of serious accident. The average price of a new car in the United States today is over $48,000. The state minimum coverage wouldn't even cover the cost of replacing the high-tech headlights and bumper sensors on many modern vehicles, let alone the entire car. So what is the right amount of coverage? Here's the good news. Increasing your property damage limit is one of the cheapest and most valuable upgrades you can make to your auto policy. The first $5,000 of coverage is the most expensive part. Each additional dollar of coverage costs pennies in comparison. Going from the state minimum of $5,000 to a much safer $50,000 limit might only increase your premium by a few dollars a month. Going from $50,000 to $100,000 is often even cheaper. So let's talk numbers. What should you actually have? At an absolute rock-bottom minimum, you should never carry less than $50,000 in property damage coverage. This will cover the total loss of most vehicles on the road, preventing that nightmare subrogation scenario in a typical one-car versus one-car accident. But even that can be tight. A better, and highly recommended, level of coverage is $100,000. This gives you a crucial buffer. It means if you total a new $60,000 pickup truck, you still have $40,000 left over to cover any other damage, like hitting a second car, a guardrail, or a utility pole. And trust me, you do not want to see the bill a town sends you for replacing a utility pole. Can easily run into the tens of thousands of dollars. For those with more assets to protect, a home savings investments, you should seriously consider carrying $250,000 or more. The cost to go from $100,000 to $250,000 is usually surprisingly small, and it provides a fortress of protection for your financial well-being. It ensures that one bad day on the road doesn't undo a lifetime of hard work and saving. So I urge you right now, or as soon as this video is over, pull out your auto insurance policy. Find the declarations page. Look for Part 4, damage to someone else's property, and see what your limit is. If it says $5,000 or $10,000 or even $25,000, you need to call your agent today. Not tomorrow, not next week. Today. For the price of a couple of coffees a month, you can increase that limit and buy yourself true peace of mind, protecting yourself and your family from a completely avoidable financial catastrophe. So we've covered hurting people and we've covered breaking their stuff. But what happens when the other driver is the one at fault? And they have no insurance, or even worse, they have those state minimum limits we just talked about. How do you protect yourself from them? That's where things get even more interesting, and it's what we're covering next. So let's set the scene. You're sitting at a red light, maybe you're humming along to the radio, thinking about what to make for dinner. Suddenly, bam, a bone-jarring jolt from behind. You're thrown forward, your seatbelt locks tight, and the sound of crunching metal and shattering glass fills the air. You're shaken, your neck is already starting to ache, but thankfully you seem to be mostly okay. You get out of the car to see the front of the sedan that hit you crumpled into your rear bumper. The other driver, a young kid, gets out. He's panicked, apologizing profusely. "I'm so sorry, I was looking at my phone, I didn't see the light change." You do all the right things. You exchange information. But when you look at his insurance card, it's expired. He looks down at his shoes and mutters, "Yeah, I let it lapse. I was going to get it reinstated next week. I'm so sorry, I don't have insurance." In that moment, a cold dread washes over you, because you realize all that bodily injury to others coverage we just talked about, that $250/500 policy you wisely purchased, it does absolutely nothing for you right now. Remember, that coverage is to pay for the injuries you cause to other people. It's a shield to protect your assets from a lawsuit. It is not, in any way, shape, or form, a fund to pay for your own medical bills when someone else is at fault. So what happens now? The person who is legally and financially responsible for your aching neck, your potential physical therapy, your lost wages from time off work, has nothing. You can sue him, sure. But what are you going to get? If he couldn't afford a few $100s for an insurance premium, do you really think he has $50,000 in assets sitting around for you to claim in a lawsuit? This is what we call being judgment-proof. You can win the case, but you can't collect a dime. This is not a rare, one-in-a-million scenario. The Insurance Research Council estimates that 1 in 8 drivers on the road is uninsured. 1 out of every 8 cars that passes you on the Pike or Route 9 could be a financial time bomb waiting to go off. So how do you protect yourself? This is where we introduce the first hero of our story, uninsured motorist bodily injury coverage, or UM. This coverage is your personal safety net. It's the insurance you buy for yourself to protect yourself from the uninsured. Think of it this way. When an uninsured driver hits you and is at fault, your own insurance company steps into the shoes of that uninsured driver. They essentially pretend to be the at-fault driver's insurance company and pay you for your injuries, your pain and suffering, and your lost wages, up to the limits you selected. In Massachusetts, the state minimum you're required to carry for uninsured motorist coverage is, you guessed it, $20,000 per person and $40,000 per accident. And just like with the liability coverage, this is a terrifyingly low number. Imagine that fender bender wasn't so minor. Imagine the ache in your neck turns out to be a herniated disc requiring surgery. The ambulance ride, the ER visit, the MRI, the surgeon's fees, the anesthesiologist, the hospital stay, the months of physical therapy. How quickly do you think you'll burn through $20,000? In the modern American healthcare system, that amount is gone before you've even had your first follow-up appointment. So, just as you wouldn't carry state minimums to protect your assets from others, you absolutely should not carry state minimums to protect your own body from others. The logic is simple. If you believe you are capable of causing $250,000 worth of injury to someone else, you must also believe someone else is capable of causing that same amount of injury to you. You should carry limits that are at least as high as your bodily injury to others' limits. You are protecting your most valuable asset, your health and your ability to earn a living. But wait, there's a second, even more common and insidious villain on the road. It's not the driver with no insurance. It's the driver who has insurance, but only has that pathetic 2040 state minimum policy. This is the underinsured motorist. Let's replay our scenario, but with a twist. You get rear-ended. The person is at fault. They have insurance and they proudly show you their proof of coverage. You breathe a sigh of relief. But the accident is more severe this time. You've suffered serious injuries. Your medical bills climb to $100,000. You're out of work for 3 months, losing another $20,000 in wages. You have a legitimate claim for $120,000. You file a claim against the at-fault driver's insurance. Their adjuster is very polite. They agree their driver was 100% at fault. They agree your injuries are legitimate. And then they say, "We are happy to tender our client's full policy limit to settle this claim." And they send you a check for $20,000. Your jaw hits the floor. You say, "But my bills are $120,000. And they calmly reply, "I'm sorry, but that's all the coverage our client purchased. That is the maximum we are contractually obligated to pay. You are now short $100,000. Again, you can sue the driver personally for the difference. But you run into the same problem. The person who only buys state minimum insurance is almost never the person who has $100,000 in the bank. They're driving a 15-year-old car, they rent their apartment, they live paycheck to paycheck. They are judgment-proof. You are stuck with the bill. Your life has been turned upside down by someone else's mistake, and their responsible decision to buy insurance has left you financially ruined. This is where the second hero of our story comes in. Underinsured motorist bodily injury coverage, or UIM. This coverage is brilliant in its simplicity. It pays the difference between the at-fault driver's low limit and your own higher limit. In Massachusetts, your uninsured and underinsured motorist coverages are bundled together. The limits you choose apply to both situations. So let's go back to our example. You were smart. You took our advice. You have underinsured motorist limits of $250,000 per person. The at-fault driver's insurance paid you their full limit of $20,000. Now you can turn to your own insurance company and make an underinsured motorist claim. Your policy limit is $250,000. The other driver's policy limit was $20,000. The difference is $230,000. That is the amount of coverage now available to you from your own policy to cover your remaining damages. Your total damages were $120,000. You already got $20,000 from the other guy. So your insurance company will pay you the remaining $100,000. You are made whole. Your medical bills are paid. Your lost wages are covered. Disaster averted. All because you spent a little extra on your own policy to protect yourself from this exact situation. This is, without a doubt, one of the most important coverages you can buy. It is arguably more important than the liability coverage we talked about before. Because while bodily injury to others protects your money, UM and UIM coverage protects your body, your health, your family, and your financial future. It is the coverage that pays you. When you're looking at your policy, you should see one line item for uninsured/underinsured motorist bodily injury. Insist on matching these limits to your bodily injury to others' limits. If you have 250/500 for them, you need 250/500 for you. If you have $1 million umbrella policy, you need to make sure your UM/UIM limits are high enough to satisfy the umbrella requirements, usually 250/500 or even 500/500. Don't let an agent talk you down on this. Don't try to save $40 a year on this specific coverage. It is the shield that protects you and your family from financial catastrophe caused by someone else's bad decision. We've now covered injuries to people in exhaustive detail, the injuries you cause to others, and the injuries they cause to you. We've built a fortress around your health and your assets. But what about the cars themselves? In all of our scenarios, your car was damaged or even totaled. Who pays for that? What happens when that uninsured driver doesn't just send you to the hospital, but also turns your brand new SUV into a heap of scrap metal? Does your liability coverage fix it? No. Does the other guy's non-existent insurance fix it? Absolutely not. So where does the money come from to repair or replace your vehicle? That involves a completely different set of coverages, and it's where most people get tripped up next. So let's walk through this nightmare scenario. You're sitting on the side of the road. Your car, your beautiful, reliable, get-you-to-work everyday car, has a front end that now looks like a crumpled accordion. The other driver, the one who ran the red light, has just been informed by the police officer that his insurance lapsed 2 months ago. He has no coverage. He shrugs his shoulders and says he has no money. He's what we call judgment proof. You can sue him, sure. You might even win. But you can't get blood from a stone. Winning a lawsuit against someone with no assets is like winning a gift certificate to a store that went out of business. It's a piece of paper that means nothing. Meanwhile, you still have a crumpled accordion in your driveway. You still need to get to work on Monday. You still have a car payment due next week. This is the moment where your heart sinks, because you realize the other guy's irresponsibility has become your catastrophic financial problem. Unless you have the right coverage on your own policy. This is where we move from the world of liability, paying for damage you cause to others, into the world of protecting yourself and your own property. The first and most critical piece of this puzzle is called collision coverage. The name is pretty straightforward. Collision coverage pays to repair or replace your vehicle if it's damaged in a collision with another object. That object is usually another car, but it could also be a telephone pole, a guardrail, a fire hydrant, or the side of your own garage if you have a bad morning. The key word is collision. If your car is damaged because it hit something, this is the coverage that kicks in. It doesn't matter who is at fault. This is the single most important thing to understand about collision coverage. Let's go back to our uninsured driver. He was 100% at fault, but because he has no insurance, your collision coverage becomes your superhero. You call your insurance company, you file a claim, and they handle it. They will pay for the repairs to your car. Or if the car is declared a total loss, they will pay you its actual cash value. That's the value of the car right before the crash happened. Now, it's not completely free money. There's a catch, and it's called a deductible. Your deductible is the amount of money you have to pay out of pocket for the repair before your insurance company starts paying. Think of it as your share of the cost. The most common deductibles are $500 or $1,000. Let's say your car has $8,000 in damage, and you have a $500 collision deductible. You pay the body shop the first $500. Your insurance company then pays the remaining $7,500. If you had a $1,000 deductible, you'd pay the first $1,000, and your insurance would pay the other $7,000. Why would anyone choose a higher deductible? Simple. A higher deductible means a lower insurance premium. You're telling the insurance company, I'm willing to take on a little more financial risk myself in a crash, so please charge me less every month. If you have a healthy emergency fund and can easily write a check for $1,000, a higher deductible might be a smart way to save money on your premiums. If a $500 surprise expense would wreck your budget, a lower deductible is the safer bet. Here's the magical part. If the other driver was at fault and did have insurance, your collision coverage is still your best friend. Why? Because dealing with another person's insurance company can be slow. They might drag their feet. They might argue about who was at fault. Instead of waiting, you can just use your own collision coverage. You pay your deductible, you get your car fixed immediately, and you get on with your life. Then, behind the scenes, your insurance company goes to war for you. This process is called subrogation. They go to the other driver's insurance company and say, hey, our client wasn't at fault. You owe us for the money we paid to fix their car. They fight that battle so you don't have to. And here's the best part. If they are successful in getting the money from the other company, they will also get your deductible back for you. A few months after the accident, you could get a surprise check in the mail for $500 or $1,000. Now, in Massachusetts, collision coverage is optional. The state does not force you to buy it. However, if you have a loan or a lease on your car, your bank will. The bank is the true owner of the car until you pay it off, and they are not going to let you drive around in their asset without it being protected. But if you own your car outright, the choice is yours. The decision comes down to a simple question. Can you afford to replace your car tomorrow with cash? If your car is worth $15,000 and you don't have $15,000 sitting around, then going without collision coverage is a high-stakes gamble. But collisions aren't the only way a car can be ruined. What happens if you walk out to your car in the morning, and a massive tree limb has fallen and crushed your roof? What if you're driving down a country road at night, and a deer jumps out in front of you? What if a hailstorm makes your car look like a golf ball? What if someone steals your car from a parking lot? A collision didn't happen in any of these cases, so collision coverage won't pay a dime. This is where the second part of protecting your vehicle comes in. Comprehensive coverage. It's sometimes called other than collision coverage, which is actually a more accurate name. Comprehensive coverage protects your car from damage from, well, almost everything else. Fire, theft, vandalism, falling objects, floods, hail, hitting an animal. It's the coverage for all the weird, unpredictable, non-crash related disasters that can befall a vehicle. Just like collision, comprehensive coverage is optional unless you have a loan or lease. And just like collision, it has a deductible. You might even choose a different deductible for comprehensive than you do for collision. For example, you might feel a collision is more likely, so you want a lower $500 deductible there. But you're willing to risk a $1,000 deductible for less common events like theft or hail. Together, collision and comprehensive are what people are usually talking about when they say they have full coverage. They are two separate coverages, but they work as a team to protect the physical value of your vehicle from almost any threat. One covers the crashes, the other covers the chaos. So let's bring this all together. We have liability coverage to pay for the damage we cause to other people. And we have collision and comprehensive coverage to pay for damage to our own car, regardless of who is at fault. It seems like we have everything covered, right? Your car can be completely rebuilt or replaced. The other guy's car is taken care of. Everyone's property is secure. But we've been talking entirely about metal, plastic, and glass. We've completely ignored the most fragile and important things involved in any car accident: the human beings inside. What happens to you? What happens if you break your arm in that crash with the uninsured driver? You have health insurance, right? You might think that's the end of the story. But what about your health insurance deductible? Your co-pays? What about the wages you lose from being unable to work for 3 weeks? Your health insurance certainly isn't going to cover that. So your car is fixed, but you're at home with a cast on your arm, watching medical bills pile up on the kitchen table while your income has dropped to zero. Who pays for that? The answer is far more complicated than you think, and in Massachusetts, it all comes down to a mandatory but widely misunderstood part of your policy called personal injury protection. Personal injury protection, or PIP, is the unsung, overworked, and often invisible hero of your Massachusetts auto policy. It's designed to answer one critical question immediately after a crash. Who pays for the ambulance, the emergency room, and your first few weeks of lost income? Right now, without waiting for the insurance companies to spend months fighting over who was at fault. This is the entire foundation of Massachusetts being a no-fault state. And let's clear this up right now, because that term, no fault, causes massive confusion. It does not mean nobody is ever at fault for an accident. Oh, believe me, fault is a very big deal, and we'll get to exactly why in a later part. What no fault actually means is that for the initial, most immediate costs of an injury, it doesn't matter who was at fault. Your own insurance policy steps up to the plate first to pay for your own injuries. It's a system designed for speed, to get you medical care and financial help without delay. So you're in that ambulance. A bill is generated. You get to the hospital, you see a doctor, you get an x-ray. More bills are generated. Who gets them? Under the PIP system, these initial bills go directly to your own auto insurance company. And here is the first critical number you need to know: $2,000. Your personal injury protection will immediately pay up to the first $2,000 of your reasonable and necessary medical expenses. No questions asked about fault. It doesn't matter if you caused the crash, or if the other driver was texting, driving backwards, and juggling flaming torches. The first $2,000 of your medical bills are covered by your own PIP. This prevents you from getting a collections notice from the hospital, while the other driver's insurance company is still trying to decide if they're going to accept liability. It's an immediate financial buffer. But let's be honest. In today's world, $2,000 doesn't go very far. An ambulance ride and a few stitches can burn through that in a heartbeat. What happens when your medical bills hit $2,001? This is where the system gets incredibly clever, and where almost everyone gets it wrong. You might assume that your PIP just keeps paying all the way up to its limit. But that's not what happens. The moment your medical bills exceed $2,000, the law says that your primary health insurance, your Blue Cross, your Tufts, your Harvard Pilgrim, whatever you have through work or the marketplace, must become the primary payer. Your auto insurance company literally sends the remaining bills over to your health insurance company for payment. This is called coordination of benefits. It's a way to keep auto insurance premiums from skyrocketing by leveraging the healthcare system we all already pay for. So, your health insurance steps in. It pays the doctors, the hospital, the physical therapist according to the terms of your health plan. You'll still be responsible for your health insurance deductibles and copays, just like you would be for any other medical treatment. Now, a giant question should be popping into your head. What if I don't have health insurance? Or what if I have a super high deductible plan and can't afford the $5,000 deductible? Does that mean I'm just out of luck? No. The system has a safety net for this exact scenario. If you don't have health insurance, or if your health plan denies the claims for some reason, then your PIP coverage reactivates. It will then continue paying your medical bills beyond that initial $2,000 mark, all the way up to its own limit. And what is that limit? The mandatory state-required limit for personal injury protection in Massachusetts is $8,000 per person, per accident. That's the total pot of money available from PIP to cover everything. And everything doesn't just mean medical bills. Remember the other half of the nightmare scenario? You're injured, you can't work, and your paychecks stop. This is the second superpower of PIP, covering lost wages. If your doctor writes you a note saying you can't work for, say, 4 weeks because of your injuries from the crash, PIP will pay you for a portion of that lost income. Specifically, it will reimburse you for up to 75% of your average weekly wage. So if you typically earn $1,000 a week, PIP will pay you $750 a week while you recover. This is an absolute lifeline. It's the money that keeps the lights on and buys groceries when you are physically unable to earn a paycheck. But here's the catch. It all comes from the same $8,000 pot. It's not $8,000 for medical and another $8,000 for lost wages. It's $8,000 total. So if you have $5,000 in medical bills paid by PIP, you only have $3,000 left available to cover any lost wages or other expenses. You can see how quickly that $8,000 can get eaten up in a moderately serious accident. Now, who exactly does this amazing coverage apply to? It's broader than you might think. PIP covers you, the person named on the policy. It also covers any member of your household. It covers anyone who was driving your car with your permission. And it covers any passengers who were in your vehicle at the time of the crash. Gets even better. It also covers you and members of your household. If you are a pedestrian or a bicyclist, and you are struck and injured by a Massachusetts vehicle, your own auto policy's PIP will step in to pay your initial bills, even if your car was parked safely in your driveway miles away. The coverage follows you. The one major exception here is for motorcyclists. For a variety of complex reasons, the standard Massachusetts motorcycle policy does not include PIP coverage. This is a critical vulnerability that every rider needs to be aware of and plan for using other coverages, like medical payments, which we'll discuss soon. Of course, this coverage isn't a blank check. There are certain actions that will get your PIP claim denied, and they're exactly what you'd expect. If you were injured while driving under the influence of alcohol or drugs, your claim will be denied. If you were committing a felony, like fleeing from the police, it's denied. If you intentionally caused the accident, it's denied. The system is designed to protect innocent victims, not reward reckless or criminal behavior. There's one last detail you need to know, and it's a choice you make when you buy your policy. You can choose to have a PIP deductible. You can select a deductible of $100, $250, $500, $1,000, $2,000, $4,000, or even the full $8,000. Choosing a deductible will lower your premium, sometimes by a noticeable amount, but it comes at a massive risk. If you choose a $2,000 deductible to save $100 a year on your premium, you are personally on the hook for that first $2,000 of medical bills if you get into an accident. And if you have a health insurance plan that also has a deductible, you could end up paying both. It's a gamble that can backfire spectacularly. So let's put it all together. PIP is your first line of defense. It pays your initial medical bills and lost wages quickly, regardless of fault, up to a total of $8,000. It's a fantastic, essential system for minor to moderate injuries. But what happens when the injuries aren't minor? What happens when you need surgery, months of physical therapy, and you're out of work for half a year? That $8,000 will be gone in the blink of an eye. You might have 10, 20, 50, even hundreds of thousands of dollars in medical bills and lost income. Pay has done its job, but it's an empty bucket. You're facing financial ruin, and it was all because someone else ran a red light. Now what? Who pays for the rest? This is where the concept of fault comes roaring back into the picture. Because once you cross a certain threshold of injury, the no-fault system gives you a green light to go after the person who actually caused your pain and suffering. And how you do that and what part of their insurance policy is designed to pay for it is the single most important liability coverage on your entire policy. It's called Part 5, Optional Bodily Injury to Others. And that little word, optional, is one of the most dangerous words in the entire insurance industry. Because while the state of Massachusetts says you don't technically have to buy it, not having it or not having nearly enough of it is like driving around with a financial time bomb strapped to the roof of your car. This is the part of your policy that pays for the pain, the suffering, the lost wages, and the staggering medical bills of people you injure in an at-fault accident. This isn't for a fender bender. This is for when you change someone's life for the worse, and it can happen in a split second. Let's imagine a scenario. You're a good driver. You've never had an accident. You're driving home from work on a Friday, maybe you're thinking about the weekend, and you glance down at your phone for just 1 second to see who texted you. In that 1 second, the car in front of you, a minivan with a baby on board sticker, slams on its brakes. You look up, but it's too late. You hit them. Doesn't even seem that bad. You're going maybe 25 miles per hour. The bumpers are crunched, everyone gets out a little shaken up, but they say they're okay. You exchange insurance information, the police come, a report is filed. You feel terrible, but you think, okay, that's what insurance is for. My company will fix their van. A week later, you get a letter in the mail. It's from a law firm. The woman you hit, the driver of the minivan, is now experiencing severe back and neck pain. She's been to the emergency room, she's seeing a chiropractor and orthopedic specialist. She can't go to her job as a nurse. She can't pick up her child. The letter informs you that they are officially making a claim against you for her injuries. This is where Part 5, Bodily Injury to Others, kicks in. This is your shield. This is the army that stands between your personal assets and the person you just injured. Now let's look at the numbers on your policy. You'll see two numbers separated by a slash. It might say 20/40ths or 100/300 or 250/500. These are your liability limits, and understanding them is critical. The first number is the maximum amount your insurance company will pay out to any one single person you injure in an accident. The second number is the maximum total amount your insurance company will pay out for the entire accident, no matter how many people are injured. So, if you have the Massachusetts state minimum, which is a terrifying 20/40ths, it means your insurance will pay a maximum of $20,000 to one injured person, and a maximum of $40,000 total if you injure, say, a whole family in that minivan. Let's go back to our story. The woman you hit, the nurse, ends up needing back surgery. Her medical bills alone are over $100,000. She's been out of work for 6 months, losing another $40,000 in wages. Then there's the pain and suffering component, which a jury could decide is worth another $150,000. We are now at a grand total of $290,000. You have the state minimum 20/40ths coverage. Your insurance company writes a check to her lawyer for $20,000. That's it. That's their maximum obligation. They are legally done. But she isn't. She is still owed $270,000. And who do you think her lawyer is coming after for that money? It's not your insurance company. It's you. Suddenly, you're facing a lawsuit for $250,000. Your savings account? Gone. The equity in your home? They can put a lien on it. Your future earnings? They can garnish your wages for years, maybe even decades. Every paycheck you get, a piece of it goes to pay for that 1 second you looked at your phone. Your life as you know it is fundamentally over. All because of that optional coverage. This is not a scare tactic. This happens every single day in this country. People who think they're fully covered find out in the most brutal way possible that their coverage is a paper shield against a firestorm. Now, some people think, well, if I have high liability limits like 250/500, doesn't that make me a bigger target for lawyers? Won't they see I have good insurance and try to sue me for more? This is one of the most dangerous and widespread myths in all of insurance. Let me be perfectly clear. A good personal injury attorney doesn't decide to sue you based on your insurance limits. They decide to sue you based on your assets. Before they even file a lawsuit, they will do an asset search. Do you own a home? Do you have investments? Do you have a good job? If the answer to any of those is yes, you are already a target. Your liability insurance isn't the bullseye. It's your armor. Having low limits doesn't make you invisible to lawyers. It just means you're going into battle wearing a t-shirt. Having high limits like 250/500 means you're showing up in a full suit of plate mail with a giant shield. The lawyer sees that they're not just fighting you and your empty bank account. They're fighting a massive insurance company with a $250,000 war chest ready to defend you and pay the claim. It actually makes a settlement within your policy limits far more likely. So what limits should you have? The state minimum of 2040 is financial suicide. It's not enough to cover a moderately serious injury in today's world of six-figure medical procedures. A good starting point for most people is 100/300. That gives you $100,000 per person and $300,000 per accident. That's a respectable shield. But the gold standard, the level of coverage that lets you sleep at night, is 250/500, $250,000 per person, $500,000 per accident. For the vast majority of accidents, even very serious ones, this is enough coverage to ensure that the lawsuit ends with your insurance company writing a check, not with a lien being placed on your house. And here's the craziest part. The difference in cost between that terrifyingly low 2040 coverage and the rock-solid 250/500 coverage is often shockingly small. We're not talking about hundreds of dollars a month. For many drivers, the jump from minimum to magnificent might be $20, maybe $30 a month. It is, without a doubt, the single best bargain in the entire world of personal finance. You are buying hundreds of thousands of dollars of life-altering protection for the price of a few cups of coffee. So I urge you right now, pull out your phone, open your insurance app and look at your policy. Find Part 5, Optional Bodily Injury to Others. Look at those two numbers. If they say 20/40 or 50/100, you need to understand the risk you are taking every single time you get behind the wheel. You are one text message, one slippery road, one bad decision away from a financial catastrophe. Protecting other people from the harm you might cause is a fundamental responsibility of driving. But this coverage, this Part 5, it isn't really about them. It's about you. It's about protecting your home, your savings, your family, and your future. It's the most important number on your policy because it shields everything you've ever worked for. But injuring a person is only half of the liability equation. You can cause just as much financial devastation by hitting property. And in a world of $80,000 pickup trucks and six-figure electric vehicles, the damage you can do to someone else's things can be just as catastrophic as the damage you do to their body. Hitting a single car can now easily exceed your property damage limits, and that's before we even talk about what happens when you hit two cars or a building. Imagine for a moment you're driving on a slick, icy morning. You hit a patch of black ice, your car spins out of control, and you don't just hit another car. You slide off the road and crash directly into the corner of a small building. A local coffee shop. The sound is sickening. Glass shatters, brick crumbles. You're okay, thankfully, but the damage is done. Now let's stop and think about the bill. The state minimum for property damage in Massachusetts, Part 4 of your policy, is just $25,000. Does that sound like enough to fix a building? The coffee shop owner has to call a structural engineer just to see if the building is safe to enter. That's a few $1,000s right there. Then they need an architect to draw up plans for the repair. More thousands. Then comes the actual construction. Masons, carpenters, electricians to rerun the wiring you destroyed. The cost of materials alone is sky high. You've also shattered a massive commercial-grade plate glass window. That's another $5,000 to $10,000. We're already well past your $25,000 limit, and we haven't even talked about the stuff inside the building. You destroyed their custom-built espresso bar, a commercial refrigerator, and a display case full of merchandise. That's tens of thousands of dollars in business property. And here's the killer. The coffee shop has to close for 2 months for repairs. That's 2 months of lost income, lost profits, and wages they still might have to pay their employees. That's called a business interruption claim, and guess who's on the hook for it? You are. The total bill for this one single moment of bad luck isn't $25,000. It's $250,000. Your policy pays its limit, the first 25 grand. You are now personally, legally, and financially responsible for the remaining $225,000. That's a nightmare scenario. And it's not even the most common one. Let's go back to that icy road. Instead of hitting a building, you cause a chain reaction collision on the highway. You slide into a brand new Ford F-150. The guy behind you swerves to avoid you and clips a Tesla. The person behind them can't stop in time and rear-ends the Tesla. It's a mess. Let's tally up the property damage you caused. A new F-150 can easily cost $60,000. If it's declared a total loss, that's the bill. A new Tesla Model Y? Another $55,000. And even minor repairs on a Tesla, with its specialized parts and sensors, can run into the tens of thousands. Let's say the third car is a more modest Honda CR-V, but it's also totaled. That's another $30,000. We're at $145,000 in damage to other people's vehicles. Maybe you were smart. You didn't just get the state minimum. You bought a policy with $100,000 in property damage coverage. That's great. It's much better. But it's still not enough. After your insurance pays its $100,000 limit, you are still on the hook for $45,000. Where does that money come from? Comes from you. The other insurance companies will pay to fix their own customers' cars, and then their lawyers will come after you personally to get that money back. This is called subrogation. They will look at your assets. Do you own a home? They can put a lien on it. Do you have savings? A retirement account? They will go after it. And what if you don't have assets? They can go after your future. A court can order your wages to be garnished, meaning a chunk of every single paycheck you earn for years, maybe even decades, will be taken from you before you ever see it, until that $45,000 debt is paid. This is the terrifying reality of being underinsured. One mistake, one split second can financially ruin you. It can erase a lifetime of hard work and saddle you with a debt that follows you everywhere. So what is the answer? How do you protect yourself from these catastrophic, million-dollar scenarios without paying a fortune in insurance premiums? The answer is one of the most important and misunderstood tools in personal finance: an umbrella liability policy. Think of it exactly like its name suggests. Your auto and homeowners insurance policies are your primary protection. They're like your jacket in your hat. They handle the everyday showers, the fender benders, the slip and fall on your front steps. But what happens when a hurricane hits? What happens when you're facing a massive multi-$100,000 or million-dollar lawsuit? Your jacket and hat are soaked through in seconds. You need something more. You need a giant umbrella that covers everything. That's what an umbrella policy does. It's a separate policy that sits on top of your existing auto and home insurance. It doesn't kick in until your primary policies have paid out their maximum limit. Let's go back to our coffee shop example. The total damage was $250,000. Let's say you had a good auto policy with $100,000 in property damage. Your auto policy would pay the first $100,000. Then, instead of you being on the hook for the remaining $150,000, your umbrella policy would kick in and pay the rest. Your personal assets, your savings, your future income, they're all safe. The umbrella took the hit. The same goes for bodily injury. Let's say you cause an accident that results in a $500,000 medical judgment against you. Your auto policy has bodily injury limits of $250,000 per person. Your auto policy pays that $250,000. Then your umbrella policy kicks in and pays the other $250,000. You walk away without losing your house. Umbrella policies are sold in increments of $1 million. And now you're probably thinking, $1 million of extra coverage? That must cost a fortune. It's probably only for rich people. And that is the single biggest, most dangerous misconception about this coverage. The shocking truth is that a $1 million personal umbrella policy is incredibly cheap. For most people, you're looking at a cost of somewhere between $200 and $400 for the entire year. That's less than $1 a day. It is, without question, the best bargain in the entire insurance industry. For the price of a fancy cup of coffee once a week, you can add $1 million force field around your financial life. Why is it so cheap? Because the insurance company knows the chances of you ever needing it are low. It only gets used in those rare, catastrophic situations. But as we've seen, those situations absolutely happen. And when they do, not having an umbrella is the difference between a really bad day and a ruined life. So who needs one? Honestly, almost everyone. It used to be thought of as something for wealthy people with a lot of assets to protect. And yes, if you have a high net worth, it is an absolute non-negotiable necessity. But today, it's for anyone with a future. Are you a young doctor just starting your career? A lawyer? An engineer? You may not have a lot of assets now, but you have a massive future earning potential. A lawsuit can garnish those future wages for decades. An umbrella policy protects your future self. Do you own a home? Even if you have a big mortgage, you have equity you need to protect. Do you have a retirement account you've been contributing to? An umbrella protects it. Do you have kids who are about to start driving? Teenage drivers are a huge liability risk, and an umbrella policy covering your whole family is a critical shield. To get an umbrella policy, insurance companies will require you to have certain minimum limits on your underlying auto and home policies first. Usually, they'll want to see something like $250,000 per person and $500,000 per accident for bodily injury on your auto, and $100,000 for property damage. For your homeowner's insurance, they'll typically require $300,000 in liability coverage. They want to make sure your jacket and hat are solid before they sell you the big umbrella. Upgrading your primary policies to these limits, and then adding $1 million umbrella is one of the single smartest financial moves a person can make. It's the ultimate defense. We've spent all this time talking about protecting other people from the harm you might cause with bodily injury and property damage liability. The umbrella is the final crucial step in that process. But it's also the first step in truly protecting yourself and your family from financial ruin. We've now covered the full spectrum of your liability to others, how you pay for the damage you do to their bodies, their cars, and their property, and how to shield your own assets when those damages are catastrophic. But there's another side to this coin, a question that might be even more frightening. What happens when someone else crashes into you, and they're the one with no insurance or just the state minimums? How do you pay for your medical bills? How do you fix your car? How do you protect your family when the person at fault can't pay? That is the single most important question in all of auto insurance. Because up until now, we've been talking about your liability, your responsibility to pay for the damage you cause to other people. But the terrifying reality is that you can do everything right, be a perfect driver, pay your premiums on time, carry fantastic coverage, and still find yourself in a financial nightmare, all because of someone else's mistake. The solution is a pair of coverages that are, without a doubt, two of the most critical and misunderstood parts of your entire policy. They are your personal financial shield against the chaos of the open road. We're talking about uninsured and underinsured motorist coverage. Let's call them UM and UIM for short. Think of it this way: when you buy bodily injury liability, you are buying insurance to protect other people from you. When you buy uninsured and underinsured motorist coverage, you are buying insurance to protect yourself and your family from them. You are essentially buying the policy that the other guy should have bought but didn't. Let's start with the first threat: the uninsured driver. Nationally, about 1 in every 8 drivers on the road has zero insurance. They are driving illegally, and if they slam into you, they are a financial ghost. They have no insurance company to call, no policy to pay for your injuries. So what happens? Let's imagine a scenario. You're driving home from work, stopped at a red light and BAM. You get rear-ended. Hard. The other driver is apologetic. You exchange information, but when you call your insurance company the next day, they deliver the gut-wrenching news. The policy number he gave you is fake. He has no insurance. Meanwhile, your neck and back are in agony. The doctor says you have a herniated disc and whiplash. You're looking at months of physical therapy, doctor's visits, and you can't work for at least a few weeks. Your medical bills start piling up: the emergency room visit, the MRI, the specialist consultations. Your lost wages are accumulating. Your car is a wreck. What are your options? Well, you can sue the other driver personally. You can hire a lawyer, go to court, and you might even win a judgment for, say, $50,000 to cover your costs. But here's the brutal truth. If a person can't afford a basic auto insurance policy, what are the chances they have $50,000 sitting in a bank account? The odds are close to zero. You can win the case and still never see a single penny. You're left with a mountain of debt, chronic pain, and a worthless piece of paper from a court. This is where uninsured motorist bodily injury coverage becomes your hero. If you have UM coverage, this entire nightmare changes. Instead of chasing a ghost, you file a claim with your own insurance company. Your insurer essentially steps into the shoes of the uninsured driver's non-existent insurance company. They will pay for your medical bills, your lost wages, and your pain and suffering, all up to the limits you selected on your own policy. In Massachusetts, you are required to carry uninsured motorist coverage. The state minimum is $20,000 per person, $40,000 per accident. But as we've discussed before, $20,000 can be exhausted by a single MRI and a few weeks of physical therapy. This is why it is absolutely critical to raise your limits to match your own bodily injury liability limits. If you have two 5,500 limits to protect others, you should have two 5,500 limits to protect yourself. You are, in effect, insuring yourself against the worst-case scenario. But what about the second threat? This one is even more common, and in many ways more insidious. This is the underinsured driver. This is the person who followed the law but only just barely. They bought the absolute cheapest state minimum policy they could find. Let's go back to our scenario. This time you're in a more serious accident. Someone runs a stop sign and T-bones you in an intersection. The crash is violent. You suffer a broken leg that requires surgery, internal injuries, and a long, painful recovery. Your total medical bills skyrocket to $150,000. You're out of work for 6 months, losing another $40,000 in income. Your total damages are close to $200,000. The at-fault driver thankfully has insurance. You breathe a sigh of relief. But then the second shoe drops. His insurance company calls and informs you that he only carries the Massachusetts state minimum bodily injury liability of $20,000. That's all they can offer you. $20,000. Your medical bills alone are more than 7 times that amount. They will write you a check for $20,000, and then they will wish you the best of luck. You are now left with a $180,000 hole. Your life has been turned upside down by someone else's negligence, and because they chose to carry the bare minimum coverage, you are the one facing financial ruin. You can still sue them personally for the rest, but again we run into the same problem. You can't get blood from a stone. This is the exact scenario that underinsured motorist, or UIM coverage, was designed to prevent. UIM coverage activates when the at-fault driver has insurance, but their limits aren't high enough to cover your damages. It bridges the gap between their low-limit policy and your actual costs. So let's rewind. You have that same devastating accident. Your damages are $200,000. The at-fault driver's insurance pays their policy limit of $20,000. Now, because you were smart and bought high limits for your own UIM coverage, let's say you have 250/500 UIM limits, you can file a claim with your own insurance company for the difference. Your policy can pay you the remaining $180,000. It takes you from a catastrophic loss to being made whole. It pays for your surgery, your rehabilitation, your lost income. It allows you to focus on healing, not on bankruptcy. It is the single most powerful tool. You have to protect your financial future from a serious accident caused by someone else. Just like UM coverage, you are required to have UIM in Massachusetts, and the minimums are the same. And just like with relying on the state minimum is a catastrophic mistake. The cost to increase your and UIM limits from the state minimum of 20/40 to a much more protective level like 250/500 is often surprisingly small. We're talking about a few dollars a month on your premium. It is the single best bargain in the entire world of insurance. There is no other purchase that offers that level of financial protection for such a low cost. So let's be crystal clear. When you choose your uninsured and underinsured motorist coverage limits, you are not just ticking a box. You are placing a value on your own health. You are deciding the maximum amount your family will receive if they are seriously injured by an irresponsible driver. You are setting the safety net for your own financial life. These coverages handle the injuries to you and your passengers. But what about the damage to your car? If an uninsured driver totals your brand new SUV, their non-existent insurance isn't going to buy you a new one. This is where a different part of your policy has to step in to save the day. We've now covered your liability to others, and we've covered how to protect yourself from the financial fallout of being injured by others. The final piece of the puzzle is protecting the value of your own vehicle against any and all threats. Whether it's another driver, a falling tree, a hailstorm, or even a thief in the night. That's where we're going next. So let's talk about protecting the castle. Your car is likely one of the most expensive things you own, second only to a house. And while all the coverages we've discussed so far are about protecting you from financial ruin caused by others, these next two are about making you whole when your own property is damaged or destroyed. In Massachusetts, these are technically known as Part 7 and 9 of the Standard Auto Policy, but you'll know them by their common names: collision and comprehensive. Together, they are what people usually mean when they say they have full coverage. Let's start with collision. The name says it all. This coverage pays to repair or replace your vehicle if it's damaged in a collision with another object, be it another car, a telephone pole, a guardrail, a building, or even if your car flips over. The single most important thing to understand about collision coverage is that it pays out regardless of who is at fault. This is a monumental shift from liability coverage. If you're at fault for an accident, your property damage liability pays to fix the other person's car. Your collision coverage pays to fix your car. If another driver hits you and they're at fault, their property damage liability should pay for your car. But what if they're uninsured? Or what if there's a dispute about who was at fault that could take months to resolve? With collision coverage, you don't have to wait. You file a claim with your own company, they pay to get your car fixed, and then they go through the hassle of trying to get the money back from the at-fault driver. This is a process called subrogation. You get your car back on the road quickly and let the insurance giants fight it out. Now, collision coverage isn't a blank check. It comes with a critical component, the deductible. A deductible is the amount of money you have to pay out of pocket for a repair before the insurance company starts paying. Think of it as your share of the risk. Deductibles typically range from $250 to $2,000 or more. The most common are $500 and $1,000. Let's say you have a $1,000 deductible. You get into an accident that causes $8,000 in damage to your car. You would pay the first $1,000 to the body shop, and your insurance company would pay the remaining $7,000. If the damage was only $900, you'd be paying for the whole repair yourself because it's less than your deductible. So, how do you choose a deductible? It's a simple trade-off. The higher your deductible, the lower your premium will be. By agreeing to take on more of the initial financial risk yourself, the insurance company rewards you with a lower price. The lower your deductible, the higher your premium will be, because the insurer is taking on more of the potential cost. The best advice is to choose the highest deductible you can comfortably afford to pay at a moment's notice. Could you write a check for $1,000 tomorrow without it causing a major financial crisis? If so, a $1,000 deductible might be a great way to save money on your premium. If $500 would be a stretch, then you should stick with a lower deductible. And one final crucial point. If you have a loan or a lease on your vehicle, the bank or leasing company will almost certainly require you to carry collision coverage. They have a financial stake in that car, and they want to make sure their asset is protected until you've paid it off. The second half of the full coverage equation is comprehensive coverage, or as it's sometimes called, other than collision coverage. This is your protection against a whole world of chaos that has nothing to do with a typical traffic accident. Comprehensive covers damage to your car from things like theft, vandalism, fire, floods, hail, windstorms, falling objects like tree limbs or ice, and hitting an animal like a deer. Think of it as the act of God and act of criminals policy. If a hailstorm turns your car's roof into a golf ball, that's a comprehensive claim. If you come out in the morning and find your car has been stolen, comprehensive coverage will pay you its value. If a deer jumps out in front of you on a country road and you can't avoid it, the damage is covered under comprehensive, not collision. Just like collision, comprehensive coverage has a deductible that you choose, and it works the exact same way. You can even have different deductibles for each. For example, you might have a $1,000 deductible for collision but a lower $500 deductible for comprehensive, since things like a cracked windshield from a flying rock are more common and less expensive to fix. And again, just like collision, if you have a loan or lease, your lender will mandate that you carry comprehensive coverage. They want their asset protected not just from crashes, but from thieves, floods, and falling trees too. So, when would you not want collision and comprehensive? The decision comes down to a simple cost-benefit analysis of your vehicle's worth. Insurance will only ever pay up to the actual cash value, or ACV, of your car at the time of the loss, minus your deductible. Actual cash value is what your car was worth the second before it was damaged, not what you paid for it, and not what a new one would cost. It's the replacement cost minus depreciation. If you're driving an old, paid-off car that's only worth, say, $2,000, and you're paying $500 a year for collision coverage with a $1,000 deductible, you're in a tough spot. In a total loss, the absolute most your insurance company would pay you is $1,000. That's the $2,000 value minus your $1,000 deductible. You're paying $500 a year for a maximum potential payout of $1,000. At that point, many people decide to drop these coverages, bank the savings, and accept the risk of having to replace the car out of their own pocket if something happens. And with that, the puzzle is complete. We've built an entire auto insurance policy from the ground up. We started with the absolute bare minimums required by the state of Massachusetts, the liability coverages to pay for the harm you might cause to others, and the basic personal injury protection for yourself. Then we added crucial layers of protection against the most common and devastating financial threat on the road, the uninsured or underinsured driver. We fortified our own medical safety net with optional PIP and medical payments. And finally, we wrapped our own vehicle in a protective blanket of collision and comprehensive coverage, shielding its value from nearly any threat imaginable. Each piece connects to the others, creating a shield. If you cause an accident, your bodily injury and property damage liability protect your life savings from a lawsuit. If someone with no insurance hits you, your uninsured motorist coverage and your collision coverage step in to pay for your medical bills and fix your car. If someone with minimum limits hits you and your medical bills are catastrophic, your underinsured motorist coverage is there to bridge the enormous gap. If you hit a patch of ice and slide into a tree, your PIP and MedPay cover your immediate injuries, and your collision coverage handles the car. It's a complete system. I want you to do something right now. Go find your auto insurance policy. Don't just file it away. Open it up and look at the declarations page. It's that summary of your coverages, usually right at the front. Look at the numbers. 25,000, 50,000, 100,000. These aren't just random numbers anymore. You now understand what they mean. You know what each one does. You know the story it tells about your level of protection. Ask yourself, are those numbers high enough to protect my home, my savings, my future? Is my deductible set at a level I can actually afford to pay tomorrow? Am I covered if the person who hits me is one of the millions driving with little or no insurance? This knowledge is power. It transforms insurance from a confusing, mandatory expense into a financial tool that you control. It's the difference between an accident being a manageable inconvenience and it being the single event that derails your entire life. An auto insurance policy isn't just a piece of paper the RMV makes you buy. It's a financial fortress. It's a promise you make to yourself, to your family, and to every other person who shares the road with you. Now, you know how to read the blueprints. You know how to build that fortress strong. Drive safe and be protected.